In the past 3 days, I've talked to 3 different people dealing with a business account and them getting mixed up with their personal expenses. So I'm going to give you a basic illustration on what it looks like to start a very small business, and then how you track the profit from that business, what you need to pay taxes on, and how you set up just a basic plan. It's a very simple illustration, but a basic plan for what to do with that money. So here's the first thing. When you're starting a business, or maybe you've already got a side business that you're doing, the first thing you need to do is set up a separate bank account just for that business. Okay, you've got your personal account, and in your personal account, that's where you do your housing and your groceries, and maybe you give out of your personal account. You make sure that you've got your transportation taken care of out of your personal account. You have your personal expenses, and then you've got your business. And so when you're first starting a business, you want to see what you have. Maybe you start the month and you've got an extra $500 in your personal account, and you say, I'm going to start a business with $500. So you take the $500 out and you say, okay, I'm removing it from my personal account and I'm going to put it into the business. And in the business, you could buy a ton of different things with that $500. A contractor might go to Lowe's or Home Depot and buy wood and nails and a hammer and build something for someone, and that's their business. An author might go to the printing house and print maybe 50 of their books for $500, and then they go and sell those books. If you're a makeup distributor, you might buy $500 of makeup, and then you might turn around and sell it for $1,000. But what you've done is you've invested from your personal account into your business. So your business has $500. You go buy product with that $500. So you actually spend the $500. Once you've spent that $500, you now have product that you go sell, you go use that, and you make a profit with it. Well, let's say once you spend that $500, then you have an increase of $1,000. You go and you sell it all, you do a project as a contractor, you go sell a bunch of books and they do really well, and you have an increase of $1,000. The $1,000 in your account is called revenue. So you've had revenue come into your business, and the first thing you're going to do is maybe you hired someone to help you. And so you're going to maybe pay them out of that $1,000, and let's say that you pay them $100. So then you say, okay, I've got $900 left, so I'm going to take some out as savings for the business so that in the future I don't have to borrow from my personal account. I actually already have money in the business. And so you leave $500, and let's say that you leave that $500 in the account, and you just kind of move it over here in its own little business savings account. And so you've had $1,000 of revenue, you paid someone $100, you saved $100. What do you have left at the end of the month? Well, at the end of the month, you've got $400. You've got $400, and after your revenue and then your expenses and some savings, that $400 would be your profit. What you have left over at the very end of the month. And what you can choose to do with that profit is, again, you could save more of it into the savings account, or you could bring that profit home and move that profit into your personal account. And so now you've got $400 in your personal account that you can spend however you want, or you can, and you still have the savings in your business of $500 to invest into the next project. Now, I said that you've got $400 in your personal account, but I want you to know, and this is something most business owners or small business owners don't realize, is that if you own your own business, you're self-employed, then that means that you have to pay your self-employment tax and your normal federal withholding tax rate when you pay taxes. And so business owners are required every quarter, once every 3 months, to set aside money, and they send that into the government in advance saying, this is what I think I'm going to be needing to pay in taxes this year. So the way you calculate that is that if for self-employment taxes, I'm just going to say SE, and this is going to be Social Security and Medicare. It's Social Security and Medicare. I'm going to say Medicare. All right. That is 15.3% that you need to pay. 15.3%. That means that you're setting aside 15% just to pay for your own Social Security and Medicare. On top of that, you have to pay your normal federal tax rate. So you've got, I'm going to say, federal taxes. If you have state income taxes would go here as well. Let's say that you earn about $50,000 a year. That would put you in the 25% tax bracket. So you probably need to set aside at least 25% of your earnings for federal taxes, and you need to set aside 15.3% for your Social Security and Medicare. Yes, being a small business owner is very tax heavy. Now there are some tax benefits, and that's for a completely different video, because you can use money as expenses and lower your profits and take care of some other things, but totally different video. The point is here, when you bring home the profit of $400, I'm just going to write the word profit here. When you bring home the profit into your personal account, it's profit to you, but first you've got to set aside the taxes. So if we look at 25 and 15, that's almost 40% that you've got to set aside just to pay your taxes. All right, so that means out of this $400, I don't know the exact number, it's going to be about $240 that you get to keep. It's going to be $160 that you're setting aside in taxes. So you've got $160 that you're putting into taxes, and that means what you're actually getting to spend is about $240, and this is for you personally. I know it's a pretty simplistic explanation, but let me just reiterate two major things. First, track everything for the business inside of the business. Track all of your personal expenses completely separately, because at the end of the year when you do your taxes, you're going to want to know exactly where all the money went. You're going to want to learn. If you invest $500 into the business and you get $1,000 out as revenue, what are your expenses? What do you need to save for future projects? What's your real profit? And when you get that profit, how much do you actually get to take home and spend, because you do have to pay taxes on that profit personally. All right, very simplistic, but I think it's important to know that. The other thing most people forget is just the self-employment taxes. That's the Social Security and the Medicare, along with your federal tax rate and your state income tax rate. And I don't know what your state income tax is. In Texas, it is 0. There's no state income tax, but in your state it might be different. So you could end up giving up more than the original 40% of your profits into taxes. So just remember this, because if you don't set the money aside every quarter, then you can get in big trouble with the IRS, and they will come after you for that money. All right, I hope this was helpful, just understanding the difference between personal and business accounts. Thanks.